Chavanez? Here. Mr. Suckowitz?
Here.
Supervisor Jurdy?
Here.
Mr. Stevens?
Here.
Mr. Walker?
Here.
Mr. Knudsen?
Here.
Ms. Harris?
Happily here.
Ms. Shatmeyer? Here. Mr. Goodman?
Here.
And Mr. Shoemaker? Everyone's here. Yeah.
Alright, rise for the pledge of allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
We have to work on the start. We have to work on the start.
Yeah.
Say, please join.
Ready, begin.
Yeah,
Alright,
please join.
any public comment? Any
Yep.
corrections to the minutes of the board meeting held August 17th, 2016? Okay,
Oh, you have one.
no objections, no corrections, minutes of the board meeting held August 17th, 2016 passed with unanimous consent. Consent agenda, any objections, changes to the consent agenda? Okay, consent agenda passes with unanimous consent. Discussion, nope, don't need that one. Discussion and possible action regarding investment report. Dr. Wilbanks.
Thank you, Mr. Chairman. I believe we have Greg and Alina here from Callan, and they'll go over, they have two items to cover with us, the monthly investment report and a presentation on real estate, and I'll turn it over and let them take it from there. Great. Hey guys, how are you?
Good morning, Greg.
Morning.
Okay, great. So we have a couple things to go over. First is you have the monthly report. The little flash report. Just to report quickly, I think it's great information to have on a monthly basis, take a look at, but I don't overly dwell on the returns over such a short time period. You want to look at longer term performance. But at the end of August, assets stood at $443.5 million. In the month, there were investment gains about $2.4 million. And it's because there were modest gains in the stock market. So not surprisingly, your stock portfolio for the month was up 0.7%. Over the same time period, international stocks rebounded a little bit more, up 1.3%. Bonds were essentially flat. And your real estate portfolio, in part because of the REIT portfolio, was down 0.7%. All in for the month of August, the total fund was up about half a percentage point. Over the last year, I was looking at this last night. Over the last year, performance is positive, up about 6%, but you're behind your target. And in part, that's because of the growth equity managers. I think we should spend a little bit more time to go through the performance on these longer time periods at our standard quarterly performance review time periods. Looking at these, it's good to see it on a month-to-month basis, but it's easy to put excess emphasis on performance over these short time periods. So any questions about that? What we came up today to spend a little bit more time talking about is your real estate portfolio. And that's where we have this larger presentation. Recall that we just wrapped up an asset allocation study. And in that asset allocation study, we all came up to the decision to change the policy target a little bit. You increased real estate just a little. You decreased fixed income a little bit, and you increased international equity decision, your asset allocation decision, is the big investment decision you make. It's the largest and most important one you make. After that, the next most important decisions you make are, how do I structure each individual asset class? What do I do within real estate? What do I do within domestic equity? What do I do within international equity? What do I do within fixed income? Those are the second most important decisions you make. We call those decisions manager structure. So now that you went through and you did your the asset allocation work, we're going to walk through each asset class over the next several months and either confirm what you're doing is appropriate or decide to make small changes or dramatic changes if you are so inclined. So the first asset class we're going to talk about today is real estate. I'd say it's the simplest of your structures you have. So we thought we'd start off with this asset class to give you a sense of what process we're going to go through for each asset class. And it's because it's the easiest one to do, we're just going to knock it off at first. The way we structure the presentations is to first tell you what you have, then give you a broad overview of the asset class, do some definitional things, it's education, and then at the end we'll give you two alternative structures that we think is reasonable for you to consider, and from there you might make a decision to either keep what you have or make a change. Okay? So the first bit of the presentation here is going to be more educational in tone. So on page 3 here, we'll give you a quick overview of real estate. And what real estate is, it's private and public investment in commercial real estate. A lot of times when we as individuals think about real estate, we think of our house. That's not what you're invested in. You're not invested in people's houses. You're invested in commercial real estate. There are 3 common types of private real estate strategies, and we'll make the distinction going forward of what private real estate is versus public real estate. But the 3 common types of private real estate are core, value-added, and opportunistic. Those are kind of the 3 major buckets of private real estate. Then there's public real estate, and when we talk about public real estate, what we mean by public is that it is publicly traded on exchange. So public real estate refers to REITs, real estate investment trusts. So you as an individual, you can go out and you can buy a REIT, right? You as an individual, unless you have an awful lot of money and you're a qualified investor, you can't go out and just buy private real estate on your own, at least one of these funds on your own. But you could go out and you could invest in a real estate investment trust. Why do you invest in real estate? Well, real estate provides a competitive return with a strong income component. It provides diversification relative to the stock and bond markets. And it offers inflation protection over the short and the long run. So those are the few of the key attributes that you like about real estate: diversification, income, and inflation protection. Okay? Those are a few things that you don't necessarily get from a few of your other asset classes. Now, the primary drawbacks of real estate are that they're not liquid. They're generally not liquid investments. If you have a commercial property, you can't just get up and sell it the next day. It takes a while for you to do that. Or if you invest in a real estate fund, it often has a liquidity queue of a procedure where if you put in for redemption, you don't get the money back for several months, a few months, 3 months. So that's the primary drawback of private real estate, less liquidity. The primary drawback of real estate investment trusts, or REITs, is that they are more volatile than private real estate. The volatility, we'll show you some charts there later, volatility is high. And on top of that, the REIT market is more highly correlated with the stock market, in particular small cap stocks. So the REIT market doesn't give you the same diversification benefit that we were describing up front. Private real estate is common among large institutional investors like yourselves. REITs are common, but as the real estate program grows, as you have more money dedicated to real estate in general, the amount of money you have generally allocated to private real estate tends to shrink. Because if you have enough money in real estate, you can get all the benefits of the private real estate that you want without the volatility and liquidity that you get in the REIT market. Okay? So kind of a general rule of thumb there. On page 4, let's ground and take a look at what you currently have. So currently, you have four real estate investments. The first real estate investment, I'll just touch on quickly, is this building, Kings Court, which you carry at $864,000. Callan doesn't advise on that. You know, we don't opine upon individual properties like that. And we're excluding this from the analysis. It's 2% of your real estate allocation. It's not the other real estate funds have a much more meaningful impact on your portfolio. After that, you have 3 other investments. You have 20% of the real estate allocation allocated to REITs, so that public real estate market. You then have 80% allocated to core open-ended private real estate funds, of which you have 2 funds. You have REEF America 2 and the Cornerstone Patriot funds. Those are the 2 core open-ended private real estate funds you invest in. Okay. Your new policy target moved the real estate allocation from 9% up to 11%. So now you're going to have a little bit more of your assets in real estate going forward. Okay. Let's flip ahead to page 5. And I'll provide a little backdrop on, real estate. I mentioned earlier that from left to right you have private real estate and public real estate. So the private real estate, that's where you have 80% of your money, and the public real estate is where you have 20% of your money right now. And within this real estate portfolio we're talking about, you have real estate equity as opposed to real estate debt. So when you invest in real estate, you can invest in 2 things. You can own the property, and that's when you own something, it's the equity, right? Or you could have the debt associated with a property, and that's debt, right? You can own it, or someone can owe you money. Those are kind of the 2 basic investments you can make. On the private side, you can invest in certain types of private mortgages on the debt side. And on the public side with debt, you can invest in things like commercial mortgage-backed securities. You could also argue that residential mortgage-backed securities are also a form of real estate debt as well. You have this stuff in your bond portfolios. Your bond managers right now can go out and buy debt that's linked to real estate today. And they do so in your PIMCO and your Dodge & Cox bond portfolios. So we don't need to put this in your real estate portfolio, your dedicated real estate portfolio, because you already got it on the bond side. On the equity side, there are 2 pieces. There's the REITs and then the commercial real estate that you could be owning on the equity side. On page 6, let's take a quick look at the global institutional real estate market size. And right now it's estimated that global real estate represents represents about $7.6 trillion. So it's a huge market. And then private real estate accounts for about 60% of that market, as opposed to the public real estate market, okay? By region, on the bottom right-hand pie chart here, or donut chart, I guess you call that, the universe by region, you'll see that the United States makes up about 30% of the entire global real estate market. Asia and Pacific is about an equal amount, and then Europe is also about 30%. So you put those three pieces together, it's about 90% of the market. And then you have about 10% in other regions, which tend to be emerging markets. Okay. So on page 7, up front I mentioned that there are 3 flavors of private real estate one could invest in. So these private real estate funds, there are 3 major flavors. You have core, value-added, and opportunistic. Core, and you see this is a graphical representation of how much risk and return is offered by each piece. And you'll see that core, where you have 80% of your money, is in the more conservative, liquid, lower risk, lower return category within real estate. There are higher risk and return categories such as value-added and opportunistic, but given the historic size of the real estate program, we haven't looked at these other strategies because the amount of money you need to commit for them to make a meaningful impact on a portfolio is beyond the scope of the $40 million investment that you have in real estate right now. So on page 8, core real estate, we'll note that core real estate is the most conservative equity real estate approach, and it's the one that is the anchor to most institutional portfolios. So by having the anchor allocation in core real estate, you are well within the norm of what other institutional investors like you are doing. The properties within the real estate fund are high quality with quality tenants and staggered lease schedules. That's how you identify the risk within the real estate fund. And most of the properties are at least 80% leased when they're acquired by the real estate fund. Okay? It tends to have more predictable income and cash flows. It's diversified by metropolitan area. And it tends to have lower amounts of leverage compared to value-added and opportunistic. But there is leverage involved. What that means is the real estate fund might finance part of the purchase of the underlying property with debt. And that will be between 0 and 40% of the individual property. They'll take on debt to purchase that property. Historically, about 2/3 of the return for core real estate has come in the form of income. So income coming off the property. So within core real estate, the way most investors of your size access the market is through something called a core open-ended fund. So core means it invests in core real estate. Open-ended means that it lives on forever. It doesn't have a finite life. You can put money in and take money out subject to their redemption and subscription terms of the fund. But money can come in and come out. It can be subject to gates, but it lives forever. And that's different from a closed-end fund that might only be around for 7, 8, 10 years and might be really specific for individual investment thesis. There are about 25 core open-ended funds out there, and most of them are very much U.S.-centric. They tend to be appraised on a quarterly basis, and liquidity tends to be available on a quarterly basis as well. The total universe is about $200 billion. mentioned that the leverage tends to be in the 10 to 40% range. Entry and exit queues can exist. We'll show some statistics on that in a little bit. So an entry queue is when you tell them, I want to give you more money. And when you hired, when your managers, actually this Cornerstone, I think, they said, oh, you know, we'll take your money in the next 6 months. So they said, we honor your commitment to give us money, but we can only put it to work when we buy new properties, and I'll call that money from you when the time is right. In the same way, exit queues can exist as well. When if everyone wants to get out at the same time, in order to protect investors, they can say, I'm not going to give you the money at this month, but I'll give it to you 6 months from now, after we sell properties. So those are core open-ended funds. That's where you have 80% of your real estate assets. You have 20% of your assets in real estate investment securities, REITs. And again, the advantages of REITs are the higher liquidity. The fees tend to be a little bit lower than the private real estate market. But the returns are highly correlated with small and mid-cap value equities in particular. So your diversification benefit goes down in the REIT market. I think this is important for you to consider because you just increased your allocation to public stocks and you decreased your bond allocation. And your REIT exposure has a higher correlation to the stock market, which you just increased. And at the end of the day, you'll see at the end of this presentation, we'll show you an alternative structure that takes out the REIT allocation. And to me, one of the reasons you do that is to lower that overall equity risk that you have in the portfolio.
Greg, how much of that diversification do you think is real and how much is perceived? REITs are priced immediately, so we have an efficient market and we can realize the prices on the exchange. And these other funds, we have appraisals, and I know from a lot of the state work I do, appraisals are always looking in the rearview mirror. They're not forward-looking, they're not looking at today, they're looking at the rearview mirror. So I understand there are different valuations, but I wonder if that's just inherent in the appraisal process, and we're kind of fooling ourselves that they're not more coincidental than they are.
Yeah, I mean, there's definitely some truth to that. I mean, if you, but at the same time, if you put in for redemption from the real estate fund,
It would participate at that price.
you would participate at the price that they marked it. Where if you put in the redemption on the REIT fund, you would participate on that price, which goes up and down more in value. So the appraisal process does smooth the returns, but what you would actually experience if you put money in or take it out is based on those appraisal values.
So in times of 2008, 2009, what kind of difficulty was there getting out of some of those open funds?
The core open-ended real estate funds didn't experience, there could have been queues to get out of that. Where there were bigger problems were in the open-ended value-added funds, or the open-ended opportunistic funds. There were funds that were open-ended and said, I can give you money, but they were more highly levered, and they invested in more higher risk speculative investment strategies. Those funds had problems in 08, 09. The core open-ended real estate funds that are buying, the central business district of San Francisco and New York and Boston, they had less trouble. But to be clear, I mean, they could put up a gate if there is a run on the bank, if you will. Everyone wants all their money out at once, and you're sitting on an illiquid asset. What they have to do is say, you can't all have your money right now.
Yeah, being kind of naive on this investment, not participating with my client, the problem I see is, okay, we have those appraisals showing a value looking in the rearview mirror based on the historic period that the appraiser's doing. But if I actually go to sell and liquidate, I'm setting new lows in those kind of periods. And so how do you deal with, if there is a large exit, how do you deal with getting less than the appraised value in trying to liquidate to appease people that want to get out, and showing a value that's higher than that? If you had very much of an exit, you'd run into real liquidity problems there.
You would, well, so these funds can say, I'm not gonna give you the money. And if you all run out the door at once, I'll say you can't have the money until I go out and actually liquidate the property.
So that gets back to my issue, perception versus reality.
That's right, but it's in a very specific scenario where the market's down and everyone's pulling their money, right? Now, most of these funds are designed for big institutional investors like yourself. They're not designed for retail investors that yank their money in and out based on what's on in CNBC, right? So in practice, people like you want to go to your refund and say, I need $20 million tomorrow. Like, that's just not the way you operate, right? You need $1 million every year from them for payments, right? But you don't need to pull all your money out at once. So the core open-ended real estate funds are designed for institutional investors. So with that structure, there's less chance of a run on the bank.
Ms. Harris?
I've never, I can understand core. We have two presidential candidates both saying they want to increase infrastructure.
Yeah.
So would infrastructure be core?
No. So infrastructure is generally not real estate. There's a distinct category of investments called infrastructure investing. And so infrastructure investing would be where you buy the toll roads in Illinois, or you buy the rights to an airport, or something like that. So that's a totally different category of investments altogether.
And we have no real infrastructure.
You don't invest in infrastructure directly. Infrastructure can be a component to an inflation hedging real asset category. And one of the benefits of real estate is that inflation hedging component. But other investors have added infrastructure within that overall bucket of private inflation hedging assets. They've also added things like private energy. But that just adds to program complexity, and it's best suited for very large investors that can have a lot of money to put to work and can put a meaningful amount in infrastructure, private energy, core real estate, that sort of thing. Yeah.
Mr. Sakowitz?
Thank you, Mr. Chairman. So keeping in mind that REITs are publicly traded securities, if you're, say, a CFA charged with being the analyst in that industry for your company, and if you're looking at why that stock, a particular REIT, goes up and down, of course the glib answer is there are more sellers than buyers, or buyers than sellers, and I always hate that answer. How do you spend your day? What are you looking at? You're looking at relative value, you're looking at trends. If you're going to make a recommendation, a buy or a sell or a hold recommendation, what are you basing your recommendation on?
So you have Deutsche who manages a REIT portfolio for you, and they have analysts within Deutsche who make the decision: do I want to buy and sell Simon Property Group REIT versus another REIT? So they have people in there that do all that work. So it's not Callan, it's not me. I'm not a securities analyst. But what they would look at would be what they think the underlying value of the properties they hold are,
So it could be undervalued,
Yeah,
in which case it would be a buy recommendation.
that's right, they wanna go out and buy that REIT versus another. What's been really driving the REIT market of late is just income-seeking investors.
They can raise rates, rents.
Well, but also REITs have become a substitute for bonds
I see.
because they have a high yield.
Right.
And so there's been a lot of money going into income-oriented strategies because of the low rate environment for years, and the valuation of REITs have gone up considerably because of that, because the retail investor can go out and throw money into that market, and what they're really looking for is dividends coming back. REITs have this rule where they have to pay out, I think it's 90% of all their income in the form of a dividend to an investor.
Correct.
So they tend to be very high yielding securities.
When does that analyst know that a REIT is overvalued based on that income? In other words, when has the stock price outrun the potential to
Yeah.
throw off income?
I'm gonna get over my skis talking about this, but because I'm not a securities analyst, but what I would like to hear them say is I look at the intrinsic value of the underlying real estate held, and when the stock price is so much higher than the intrinsic value of the underlying real estate, then it's, we should probably sell it, but I'm not an analyst.
Thank you.
Mr. Walker?
To piggyback off of Ted's questions, and I understand the illiquidity issue, did you see much of an issue in 08, 09, or amongst the pension world?
Not in core real estate, but there were problems in open-ended value-add funds. And so, to me, the big mismatch there is leverage and being open-ended. People can pull money in and out all they want, and being highly levered into strategies that, properties that are higher risk in nature. And you kind of put a few of those pieces together, it's not a good combination. But in the core open-ended real estate funds where leverage is lower, the properties are higher quality, there wasn't the same issue.
Mr. Knudsen?
Quickly, we all hear what's happening to the Millennial Tower down in San Francisco, leaning and sinking. If we were invested in a fund that had owned that, how soon would we know it, and what could we do if it's going to be a liability, I assume, rather than an asset?
Well, it's a liability for someone, but I don't know to who.
Yeah.
I don't know if the insurance, the builder, right, who's on the hook for that, I don't know.
The place next door that drained water that they weren't supposed to drain.
Right, I mean, that's, there's some court's gonna figure all of that out.
But if we were invested in that, we would have been told, I assume, somewhere along the line?
You would, and your manager, you can get all the properties that you're invested in on a quarterly basis from the managers, if you were interested in that level of detail.
But would they be required to tell us up front? We're in that building, it's in your overall portfolio with everybody else that's invested in the fund. Do they have an obligation to tell us about something that could be?
I would consider that, I don't know if they have a legal obligation, if that's what your ask is, but I think by best practice, they should reach out and tell us.
Mr. Stevens?
Greg, yeah, I have a question for you that's coming up in the context I'd like you to comment on it as our investment consultant. In Sonoma County, a candidate that's has a long history of being in state office and local office is running for supervisors, and she's suggesting the pension plan there, which is deeply underfunded as ours, is use that money to do low-income housing. In our county, our sheriff is running a sales tax proposal for a mental health facility that'll probably pass. He isn't suggesting it in any way, shape, or form, but others have suggested that the pension fund lend the money to build a mental health facility and the tax revenue be used to pay it back. Wondering if counties are looking, using the pension funds for some of these untraditional sources of funding. Wondering as an investment consultant, what kind of comments you have on that?
Well, I think there are a few things I would take a really close and hard look at. One is the correlation of the success of that asset with the economy, which at the end of the day supports contributions into the pension plan. Right? So if overall economy is not doing well, if local housing is not doing well, tax receipts coming in may not be doing as well, ability to pay and contributions may be more difficult into the plan. So I think that correlation of your investments and the overall GDP of the county is something that I would take a really close and hard look at. I'd also take a look at who is the fiduciary for the selection, monitoring, and maintenance of that property. It's your fiduciary responsibility to make sure all of the investments in this program are suitable. And the way you handle that now is that you go out and you hire other registered investment advisors who you delegate individual fiduciary responsibility to for the selection of individual securities. I don't know who that entity would be if you go out and you invest in individual local property. So, those are a couple things I would take
Are
a
you
close look
concerned about that with our property we have here?
I'm sorry, say that again?
Are you concerned about that with the property we have here, the property we own?
You mean the Kings Court
Yeah.
Property? It's a small investment. I don't know who manages it.
Yes, you do.
There's a guy.
I don't know the process under which it is managed.
What do you think he's done with the outside right there?
Do you like this? You got rid of that.
Less is more.
Mr. Shoemaker?
So, in that specific instance that was just raised, would you not compare cost of rents for a facility like this versus your investment and cost of maintenance to see what the value of owning it is? If we had to go rent an office like this.
Yeah.
It would cost us X.
Yeah.
We own it, maintain it, it costs us Y,
Yeah.
which is higher.
Yeah.
Boom, result investment.
There's a process one can go through that could make it a very legitimate reason why you would own it as opposed to rent it.
Yeah,
But I'm not a securities or a property manager, so someone else would have to go through that process. So being a fiduciary for something, the number one most important thing you do is you make sure you go through a well-documented process to demonstrate that the investment decisions you made are reasonable.
so the issue that Mr. Stevens brought up is a 5-year sales tax initiative that is destined to supposedly generate, $37 million?
35, I think.
$35 million. And what people have suggested is we issue that money out in the form of a bond that the county would pay the proceeds from the sales tax income to pay that bond off. And so the question is, will sales tax increase over time, or this 1% additional, is it 1% or half? Half generate the money to pay the bonded debt? And if it didn't, how would the county pay the balance of the debt the sales tax didn't pay? So we wouldn't be buying a bond, we'd be issuing a bond or issuing a loan, a mortgage, a whatever to the county of Mendocino. And then under the same obligations, they pay their other bond holders and the retirement system, they would pay us back. And I'm not being a proponent, that's what I see as the simple analysis of what people are asking. But then I got one more to toss in, and you know, I brought up in the past the concept of an investment in local real estate. Sonoma County, Lake County, Mendocino County, you cannot find places to live. You know, there is a screaming need for housing, and realizing that's really close, and I think you're gonna say you need a good analyst to say building 20 houses on an existing subdivision can get a return, or loaning somebody the money to get that. And that's a big difference, owning it versus loaning it. But is that opportunistic investment? There's no houses, I have an opportunity to furnish housing, or is that somewhere down the line on your spectrum that you've got there?
Well, I guess one thing that crosses my mind is that part of the motivation might be a social issue that might be beyond the scope of the purpose of this board, but it may not be beyond the scope of other people's responsibilities for having to sit on the board. The other thing I wonder about is if there are good investments to be made, why can't those investments just go out and borrow money on their own?
Amen. There you go.
And there seems to be a lot of
Amen.
money that people can borrow right now. Why can't they just borrow money on their own? And if the issue is because people don't want to lend the money, then
Well, in this community, people are pretty tight with their money in that regard, I can testify to that.
yeah.
Institutions are super tight.
Alright,
I've got one question of our
well,
treasurer.
well, let's, we're kinda starting to digress, let Greg get us back on track here, alright?
Okay. So there are non-core strategies and value-added real estate strategies. We're not recommending that you take a look at those, given the size of the investment program. I tell you what, let's just flip ahead to page 16. And here we'll look at a few scatter charts. So these are risk return charts, and it should echo some of the comments I made about public versus private real estate along the way. The red circle, it says Mid Creek property. This is private real estate, so this is where you have 80% of your money. And you'll see that over the last 10 years, its standard deviation, it's way over to the left. It has exhibited lower amount of risk than the other asset classes over on the right. The dark blue circle, these are REITs. So this is the 20% of your portfolio, and you see that it's exhibited a higher amount of volatility and considerably higher amount of volatility over time, over to the right. And a volatility similar to that of the public stock market. Let's look at page 18. And page 18 speaks to that same relationship where REITs have had a higher level of volatility over time than the private real estate market. Here you'll see that these are rolling standard deviation. So each point of the line is 5-year standard deviation looking back, and it changes over time. And you see in the global financial crisis, that's where the volatilities spiked for everything, right? So 2008, the volatility went up. The dark blue line there is the REIT market, the one that spiked up to the highest level. And then it's come back down now that 2008 has rolled off. You'll see that the private real estate market, the green and red lines, they went up as well. So there was increased volatility during that time period, but it still stayed below the volatility of the stock market. Okay, on page 19, we have correlations to different markets. And here I'll just point out one thing. Over the last 10 years, The Nareit equity has had a 0.78 correlation to the Russell 3000. So that's a pretty meaningfully positive correlation, whereas the private real estate market is been 0.25 to 0.18, so a much lower level of correlation to the public stock market. And what I'm looking at there is comparing the Russell 3000, which is the public stock market, including large and small cap stocks, to the bottom three rows here, which are different forms of real estate. On page 22, and again, part of this is education, just so you know what you hold in the portfolio, but what we're showing here are changes in cap rates over time, capitalization rates. So think of this as essentially the dividend yield of a real estate property. It's how much income is produced by real estate over time, and that's what is used to value real estate at the end of the day. If you say, I want to make 5% on this, then you should only pay 20 times the current income, right? If you want a 5% dividend yield. If you want a 4% dividend yield, you're willing to pay more, right? So you see that cap rates have come down, and meaningfully so, since 2000, since the global financial crisis. So a lot of cap rates now are in the mid-4s, and that's pretty darn low. So to us, that's a signal that, you know, real estate is fully valued right now.
Can you explain mean variance optimization to me?
Mean variance optimization? I could, but do you really want to know?
I don't need to know? Okay.
You're right,
Mean-
you don't base it.
Mean variance optimization is a tool that people use to combine asset classes together.
I got that.
And it takes three things into consideration: the return, expected risk, and expected correlation of the assets to one another. And you use this tool, and it comes up with an efficient frontier that says this is the asset mixes you would have to have an efficient portfolio. So we used that tool, mean variance optimization, when we came up with your new recommended asset allocation.
Mr. Sackwitz.
Thank you, Mr. Chairman. Why is the standard deviation for projected risk on private real estate so high? I would have thought it would have been lower. When you compare it to, say, a hedge fund, it's almost twice what that standard deviation of projected risk is on page 20.
Yeah, so we're carrying the standard deviation of real estate at 16 in this report. And part of that has to do with what Ted was alluding to. We don't want to underestimate the variability of the return that's taken out by smoothing.
I see. Thank you.
So it's our way of being as conservative as we can be in measuring potential risk.
Thanks.
And we used all of these inputs when we came up with that, with your new asset allocation.
Very conservative. Thank you.
Mr. Stevens?
This, while we're looking at page 20 and looking at expected rate of returns, I'd like you to comment on your expected inflation projection of 2.25 for the next decade. You'd mentioned before, and James also mentioned that one of the primary differences besides the arithmetic and geometric that I bring up between you and our actuary is the difference in inflation expectation. And that's kind of the main difference in your rates of returns expectation. Do you have any comments? You did our funding study. I don't remember you commenting on the time. If with that inherent different inflation projection, the real rates of return would be fairly much the same, but the inflation expectation is different. If we continue to fund with a target rate, including the higher inflation expectation, 3.25% versus your 2.25%, do you have any comments on that? What would that do to our funding over the next decade?
If you have higher inflation,
No, if you, real rates of return are pretty similar between you
Yeah.
and the actuary. The difference is the inflation expectation. We've kind of said, well, their real rates of return are the same, so be it. It's not that big a deal. But if we continue to fund with the expectation of the 3.25% and base our contribution rates on that, which means they'd be much lower. And internally, we have a catch-up inside our plan of 3% cumulative. It seems to me we may not have a issue with our real rates of return, but we certainly will have a funding deficiency. And I was wondering if you tried to square that difference in inflation expectation when you looked at your funding study.
Yeah,
Since it's right here in
we
front of us.
did the asset liability study, and we took the, Jim Van Hewitt came up and talked about that, and we took the liabilities and we assumed that they had the calendar inflation.
Of 2.25.
Yeah, and our assets had that same 2.25. And we took those two things and did that so that it's on an apples to apples comparison. I don't recall off the top of my head what the output looked like, but we did make the liabilities act like we think they will act based on our 2.25% inflation. And then all of our outputs that we shared with you was on that apples to apples comparison.
So my question was, on your apples to apples comparison,
Yeah.
did you use contributions based on a 3.25% expectation and a 3.25% increase in salaries and a 3.25% increase? It seems to me, I understand if you change it on both,
Yeah.
you can be in an apples to apples, but it seems to me there's still a discrepancy.
Yeah.
And it's something we really haven't fully evaluated.
Yeah. I'm sorry, I don't recall if we
Yeah, let's
adjusted
get
the
us-
contribution policy.
Let's direct the questions to real estate, all right? You guys, about real estate?
I want to close what Ted did and say, can we have a discussion at a future meeting about the effect of inflation rates on our contributions and our liabilities, just that topic?
Well, that'll probably be coming up with,
Okay, thank you.
go ahead.
Okay. I tell you what, how about we flip ahead and we'll start talking about your real estate portfolio, and I'll just quickly go through the three primary investments you have. On page 26, we talk about your first and the larger of your two core open-ended real estate funds. It's called REEF America 2. It's a core strategy which incepted in 1998. You have two lead portfolio managers. It's a fully diversified, U.S.-focused core real estate strategy with a gross value, meaning all of the properties it owns represents about $12.2 billion, and the net value, if you take out the debt it has, it's about $9.2 billion. So it does have leverage. It's about a 23% leverage ratio, and in the grand scheme of things, that's a more conservative core real estate amount of leverage. It wouldn't surprise me if a lot of us sitting in this room are more highly levered on our own residential properties, at least I am. You'll see that they have about 109 properties in the fund, and there are 278 investors like yourself in the fund right now. So very diversified by property and number of investors. Cap rate, that dividend yield I was talking about, is currently about 4.5%. On page 27, you'll note that REEF has performed reasonably well for you over the last several years. They've performed very well for you, I should say, above average across the board, and beating this Odyssey, the ODCE Odyssey index. So they've done really well, and this is following about 4 years ago. They were actually functionally on watch list for you after a number of changes within the organization and a streak of poor performance. So it was good that you remained patient with them and that we didn't react too quickly about a couple concerns, legitimate concerns we had. but they have righted the ship and they've actually performed quite well for you. On page 28, we have the regional diversification. So on the left-hand chart, you'll see that they have about a third of their assets on the East Coast, about 45% on the West, 15% in the South, and then 10% in the Midwest. Okay? This Western allocation and the coastal allocation has done pretty well for them because the coasts, property-wise, have done pretty well over the past few years. The sector diversification is over on the right, and you see that they're well diversified across the four main food groups within real estate. That's office, residential, retail, and industrial. Your next fund is the Cornerstone Patriot Fund, and it has an inception date of 2004, so it's been around for about 12 years as one portfolio manager. And it also is a U.S.-focused fund. Its cap rate is a little bit higher than the REIT fund right now, but by about 7 basis points, so not that meaningful. It is a little more concentrated than the REIT fund, and it is smaller than the REIT fund. It has about $4 billion gross, and it has about 61 properties, and there are 109 investors in this fund. So it is well diversified, but the REIT fund is just frankly much bigger and more diversified than the Cornerstone fund.
But yet it seems more volatile. Why the dip in June of 2011?
The dividend payment went down in 2011. I don't have a great answer for that one-time period of June 2011, but I can get that for you, John.
Mr. Stevens?
You use, for as far as financial nomenclature, it seems that you use you're using it this here for billion?
MM is million.
I know, but
Yeah.
it here is this, so gross value of fund is, in this case, is 4 billion.
That's right.
So you're using B, T, and MM, right? Is that what I see in your reports?
Did we have BT in it? What's BT?
B for billion, T for trillion,
Oh.
and double M still for,
But yeah, double
I'm
M
just
is,
thinking of using consistent reporting when we do our stuff that you
Yeah.
do. You guys are still using M. I get chastised when I used MM.
oh, really?
I've always used it, but,
Yeah.
so you're still using MM for
For
million,
million.
and then use B and T?
Yeah, but we rarely show the B and T. Most times we just say MM, and then, so in this example, it's 4,000 million. So it's
So that's the
4
way you usually do it.
Yeah.
Thank you.
You see on regional and sector diversification, the Cornerstone Fund has a little less in the West, and that has affected their returns. And they also have this hotel, so they're a little more, they have this extra diversification component in the REIT fund with this hotel allocation. And, but for me, the one disappointing thing about Cornerstone is performance has not been great since you funded them. We still think it's a decent fund, but frankly, we're disappointed in some of the performance. Having said that, over the last 3 years, it's returned 10% per annum. So it's been a good investment overall. It's just that, maybe we could have had an even better investment over that time period.
One other question.
Mr. Sacco?
Of the four flavors are what? Commercial, residential, hotel, and land?
So office,
Office?
residential. So when they say residential, most of the time that means multifamily.
I see. Apartments?
That's right. And then retail, and then industrial. Those are the four kind of major categories that these funds tend to invest in.
Do any REITs invest in just land or ag land or timberland or?
Yeah, so I don't know about REITs, but I assume so. But there are private funds that invest in just timber.
Okay.
And they're really interesting strategies. Some of them have done really quite well. GMO, this asset manager, you may have heard of, has been very bullish on timber for a really long time.
Right.
Timber is kind of similar to infrastructure. where you could add all of these little pieces to a private real estate strategy along with private energy. If you did that, you'd go out and you'd hire a specialist timber manager and a specialist infrastructure manager and a specialist private energy manager. And then it just adds to, complexity for your total portfolio.
Yeah, I like it, and Agline has done well,
Yeah, there are ag funds as well,
yeah.
exact same thing,
They've done very well.
yeah.
Thank you.
On page 32, Deutsche also manages a REIT fund for you, so they're your public REIT manager. It's my observation that a lot of REIT managers have frankly had a hard time with the market. A lot of the returns tend to be more index-like. But having said all of that, I think REIF has done a fine job for you over the last 10 years. But their amount of outperformance isn't dramatic relative to the broad market. They remain highly diversified, and here you'll see that on the left, the top 10 holdings of the REIT universe represents about half of the portfolio. So the REIT universe is fairly concentrated. Simon Property Group is the largest, and it's about 11% of this portfolio and about the same percent of the market. So it's a lot of times when you look at a lot of these REIT funds, Simon Property Group is the largest holding in almost all of them.
How would you aggregate fees when you add the REIF management fees with the fees by, say, the holdings?
That's a really complicated question, and because like Simon Property Group is a company,
Right.
right? And they have operating expenses to run the company. So it's kind of like saying, do you include the fees for Apple to run their business?
I see.
So you're breaking my brain just trying to think that way. But that's kind of the analogy there. It's you would be looking at what's the net income and the operating income of Simon Property Group.
Exactly.
Net of the expenses they incur.
Right.
Right, kind of the same way that you do for Apple stock.
First question we always ask is about fees.
Yeah.
So you wonder what the net to our fund is, after REIF takes their cut, and after the various the managers of the holdings take their cut.
Yeah, or the companies. So these are like little companies
Right.
that they're big companies that you're
Right.
owning.
Mr. Shoemaker?
Are these all publicly traded companies?
That's right. These are all,
Are they
All REITs.
available to only institutional investors
No.
or retail?
no, you can go out and buy stock, and in fact, small cap value managers buy these stocks for you too, because they're in their index.
So how much, that was mentioned earlier in regard to some of the bond stuff we have, that there's some of this hidden in there. If you were able to, are you able to analyze how much hidden real estate is in our portfolio?
Well, yeah, I guess I could tell you how much real estate each bond manager holds, and then what's your direct real estate exposure, and I can tell you all the REITs that are held by your stock managers. So yeah, that's not a difficult exercise to aggregate up for us.
So we're really actually looking at something higher than 11% in our, if you dig deeper.
Yeah.
But no mid and large cap, only small cap, that would be the only place this would be?
You know what, I don't know if Simon Property Group qualifies as a mid-cap stock or not. I don't know the market cap off the top of
And
my
so
head.
that could be a little bit,
It could be in your large cap managers too.
okay.
Yeah, definitely. What I can tell you that it can be, I think it's 20% of the small cap value index.
Oh.
So, I mean, it's a
Big piece.
meaningful piece of the small cap value index. Yeah. So when you see financials, they just recently split out REITs and this thing they call GICS, but historically it was tucked within financials. And so financials was like 40% of the small cap value market.
It's called what?
Financials.
No,
Guaranteed investment contracts?
That-
No.
Or
GICS.
is that something
Oh,
different?
GIC, I'm
Is that
sorry,
something different?
I'm throwing out too much language. So those are global industry categorizations. So the index providers come out and they say, this is how I define the index universe. You've got utilities, you've got financials, you've got REITs, you've got industrials, consumer discretionary, et cetera. So they go out and they categorize companies, technology, in those buckets. And those buckets are, they're called GICs.
Okay.
So,
That's
sorry for the jargon.
The GICs are primarily driven by governmental reporting for tax and business classification on reporting for BLS, BEA, and those different, all the different alphabets.
More initials for you.
Yeah.
Data.
Okay, so a lot of that was education about what you have, and we shared our view of what the markets offer and their, to you, what the pros and cons are. So now let's get into a decision-making process. Okay, what do we do about our existing real estate portfolio? We have a few kind of guiding principles for any investment structure. So this page here, on page 35, you're going to see the same slide for every asset class we talked to you about. We believe when you can have active and passive, they're good complements to each other. In particular, passive makes sense in efficient markets, active makes sense in inefficient markets, or active makes sense in markets where you can't buy an index fund. And that's the case in private real estate. There's no index fund for you to invest in out there. All of our structures are intended to be well diversified and market neutral without an intended bias. So you can decide to deviate from the market. This is from an academic standpoint. You can decide to deviate from the market, but it has to be intentional. So some examples of where you do that is you might be overweight small cap stocks, for example, relative to the broad market, because you think there's a risk and an alpha premium there. Overall, all of our structures, we want to follow the KISS principle as much as possible. So keep it simple. Simple is easy to explain, it's easy to monitor, it's easy to implement. Unless there's some compelling reason that a little more complexity will really add value for you. But a lot of times, simple is actually better. Allocations to managers should be meaningful for the plan. So allocations to any asset class should be meaningful to the plan. So we generally don't recommend, you have 0.5% allocated to something because it makes no impact on your plan if it's a really small percentage. The size of the allocations is driven by how much assets you have to allocate and the amount of active risk with each asset category. Okay, so again on page 36, we mentioned that you have 20% of your real estate allocation in REITs, 80% in core real estate funds, and on page 37, we note that we have two alternatives for you to consider. You have the current allocation, which is 20% REIT, 80% private real estate. And then you have alternative A, the only other alternative we came up with that is reasonable for you to consider, and that's to get rid of the REIT allocation and to only have private real estate. So the reason you would do this is because you increased your allocation to public stocks and you decided not to invest in other diversifying strategies, whether it's private equity, hedge funds, anything else. Your stock market beta went up, and you have stock market beta in your diversifying portfolio, real estate portfolio. So by taking out the public REITs, we think you're taking just a little bit of that off the table, and you have a higher allocation now to the properties that you really want in private real estate. which is diversification, the public market, which is really the number one thing that you're looking for.
But you're giving up liquidity.
That's the cost. You're giving up liquidity. So, in talking to Stan and James, I think in practice, over all the years, you've never used the public REIT as any sort of liquidity tool. You've actually never taken it out to rebalance into core real estate. You've never needed to draw a bunch out of there. The REIT fund, its liquidity is useful when you need to make cash coming in and out in less than a 6-month time period. Right? If you know I need cash in 6 months, you can get it out of the core real estate fund. But if you need to rebalance on a weekly, monthly basis like that, you can't do that in core real estate. That's why you need the REITs. But in practice, we've actually never experienced a need for that. And that's because it's only about 10% of your portfolio. Because it's a smaller percentage of your portfolio, you don't need that, all of that liquidity there. You have all of that liquidity in the other 90% of your portfolio, which is in bonds and international stocks and domestic stocks. So on page 38, you'll see that if you looked at this portfolio over history with alternative A, so that's no REITs, your standard deviation would have been lower, but your returns are pretty much the same.
Do we have an overlay of each one of these on top of each other on a chart in this anywhere?
An overlay of,
A return overlay?
oh, so that just the historic returns?
Yeah.
I don't think we have that in here. I think this chart here is the best, simplest representation.
We can compare it on your investment performance, can't we, for five
Yeah,
years?
here we go.
So go to the very last page of the week, on page 3 of their investment performance.
Page 3.
Ted, are you looking at the monthly performance report?
Yeah. I'm looking at your monthly measurement service, monthly review. Investment measurement service, monthly review.
Yeah.
So I see 5 years of data there.
Yeah, so here you'll see that the REIT index over the last 5 years has returned about 13.8%, 13.1. And the private real estate has returned less, it's returned 11.5.
Okay, that's what I'm looking for.
So why does that make sense to take money off the table now in private REIT, in public REITs?
Right.
The only reason is if we're trying to lower, if you look at it from a Sharpe ratio or something, you can make a justification. From a pure return standpoint, you can't, right?
That's right, and this is, REITs have also been driven up by people's demand for income. And I can tell you one thing, over the next 5 years, we're not gonna make 13% in REITs.
So there's a little bit of a timing issue.
I wouldn't
Even though we
call
don't
it
have
timing.
timers, we could probably, we're selling high, let's put it that way.
I wanna rely most on the decision that you're reducing your sensitivity to the stock market.
We're further diversifying.
You're further diversifying.
We're only talking about $9 million, so, right?
You're talking about 2% of the total portfolio. Yeah, so $8-9 million.
So we should do this sooner rather than later.
No, I don't think there's a huge rush. But, if you make a decision, it could be implemented.
Interest rates are gonna raise very slowly,
Yeah.
so we keep being called anyway.
One a year.
Anybody want to make a motion?
I'll make a motion, we take their recommendation.
I'll second it.
All right,
For clarification, that would be adopting alternative A on page 37?
Yes.
Okay, so just making sure.
any Discussion?
So that is, let's see,
50/50.
That would entail eliminating the REEF public fund, rebalancing the real estate portfolio 50/50 between the REEF America 2 fund and the Cornerstone Patriot Fund.
Cash flow, do you have any issues with that?
No.
and that is Calvin's recommendation.
You know, we like to give you options to consider. We think your current position's reasonable. We think alternative A is the only other reasonable one. If I were you, I would do alternative A.
Any debate? Any? Okay, Judy, roll call.
Ms. Cavanagh?
Yes.
Mr. Sakowitz?
Yes.
Supervisor Jurdy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knutson?
Yes.
Ms. Harris?
Yes.
Ms. Shatmeyer?
Yes.
Mr. Goodman?
Yes.
Approved.
All right, motion approved unanimously. Okay, so.
Includes agenda item number 4.
I agree, thank you. Yeah, that includes, yep. Do we have anything on district manager status? Okay. All right. Thank you, Greg and Alina.
They're gonna stay with us for
Oh,
a
they
few
are?
more
Okay.
items.
Does anybody need to take a break, or Terry?
I think we can, I'm hoping we can push through
I'll make
those
grab a cup of coffee.
couple of items.
John wants to take a break.
Oh.
Not Sharon.
If you wanna grab a cup of coffee, go ahead, but we're gonna move on.
But I will take advantage of it.
All right, so we're moving on to agenda item
Look
number
at how she
5.
put it on me.
Discussion and possible action regarding
Yeah, I got
investment
questions
policy.
for you, Sharon.
Investment policy statement. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have in your board packets a red line version with a number of changes to our proposed changes to the investment policy statement. There's also a cover memo explaining a lot of the changes. I'd be happy to try to answer any questions that you may have. I will say we've done a lot of work on this. Callan's been very, very instrumental in reviewing all of this work. There's a lot of the redlining that is not really changes. It's simply moving things within the document to fit our new style that we've adopted across all of our policies. But there are I did have some comments in the redline version to let you know some things that were changed specifically. So I'd be happy to answer any questions.
Mr. Stevens.
Page 3, top of the page. When I read this, all transactions undertaken will be for the sole benefit of Ms. Harris members and beneficiaries and for the exclusive purpose of providing benefits to them, minimizing contributions to the plan, and defraying reasonable associated administrative expenses. This seems the way it's worded to play into what some accuse this board of doing, of lowballing the contributions and having the county have to pick that up, because anytime we don't meet our actuarial assumptions, it becomes 100% responsibility of the county. And if we say from the get-go that we are minimizing, if this is for the sole benefit of the members and beneficiaries, if we are minimizing contributions to the plan and defraying reasonable associated administrative expenses, it kind of bleeds into that accusation. So I suggest a rewording of that.
That language is taken almost verbatim from the 37 Act in terms of our fiduciary responsibility.
Probably why they're always also underfunded. So I'd say we take a leadership role and make sure that we have one language in here that that suggests that the members and beneficiaries pay the closest to their share of the true costs.
Mr. Shoemaker?
Contributions are attributable to members as well as sponsors, correct?
Contributions are paid by both members and plan
So
sponsors.
we're talking semantics. Why don't we semanticize it some more and put all contributions in there? I think that the reading we just heard was an interpretation due to
Or
a philosophical perspective and not what it says. And if you put all, it might help.
Or total, minimizing total contributions.
Sure, there you go. I would buy them both those.
Mr. Jordan?
Well, that's worth the change, but can you repeat which paragraph we're on page 3?
I'm on page
The first
3, the
bullet.
very first bullet point.
paragraph.
Okay.
So the change would be to put total, minimizing total contributions?
I can't make a motion.
Hmm?
I can't make a motion unless Tim leaves for coffee.
Oh, I know, I'm,
I'm not gonna make a motion, it's much ado about nothing.
Well,
I agree.
well, we're not,
the sponsor pays 5 times as much as the participants, so I don't think it is much ado about nothing.
Make a motion.
I make a motion, we reword this paragraph to correctly reflect having the members pay their fair share and to minimize total contributions. And I'll leave it up to the retirement administrator to reword that, to draft that.
I thought we were taking a break, you guys fooled me.
No, we told you we were gonna
you
continue.
could go get coffee, but we're moving on.
Oh, I didn't hear you, I didn't hear you, okay.
So you blamed it on me?
And now I blamed it on you,
So,
okay.
I'll second the motion.
Can I see what you guys are talking about?
Yeah, we're on,
Page
investment
3.
policy,
Okay,
Page 3, top bullet.
top bullet. There's, some questions on, or some questions on the wording.
Can you restate that motion, Ted?
I'd like the retirement administrator to reword
Page 3.
the top bullet point on page 3 to include having the benefits that the members pay, the accurate cost of the benefits, and to minimize total contributions to the plan. And I'll let him reword that as his wordsmith as he's done with the rest of it. But that's intent.
Something about that top paragraph.
You still second that?
Okay, we have a motion on the table. Ms. Shatmeyer?
on this, and I don't exactly know where it is right this minute, but there was something that was talking about, and it kind of reminded me of the PIMCO situation where if you had people that were running funds that you would get out of certain funds.
There's a motion on the table.
Well, we have a motion on the table, we can't, so what it is, it's
The
page
discussion's
3,
on.
Oh,
the very first bullet point.
Yeah, we should do that.
Any other,
I have a little problem with voting for something and I don't know what the wording is.
I would, I'm a little concerned with the motion as it stands because it's telling me to do something and I don't really understand exactly what it is I'm supposed to do. So I have some concerns.
Perhaps the maker of the motion could clarify that.
Okay, let's reword it right now. So we'll put minimizing total contributions in that the end of the second sentence and beginning of the third. And all transactions undertaken will be for the sole benefit of the service members and beneficiaries and I don't think, and my concern is I'd like to have language in there that shows that our goal is to have the actual accurate cost of providing benefits. So this language here, I don't think does that.
So to the maker of the motion, a question. So essentially, you're looking at replacing minimizing contributions to maximizing contributions.
No, if you look at right now, John, we have a situation where it should have been about 50-50 in the plan, and we have the sponsor paying 5 times, 46 cents on every employee dollar. It doesn't exist anywhere else in the world except these public pension plans. Anybody else would go bankrupt or offshore. And so language like this leads into
An unsustainable plan.
Well, yeah, we get a lot of criticism, so I think our language should reflect that we're trying to get the accurate cost of providing benefits to the members
Ms. Harris?
and the beneficiaries.
I'm having difficulty, and Jeff, maybe you could help, with changing this statement and still having an accurate statement of our role as fiduciary to the plan and to its members. So, right now, I'm a little confused. If we took out things such as sole and all and changed who and how we are responsible for this plan and for its members, I don't know if changing this statement is gonna screw that up, because we're all supposedly fiduciaries to the members of the plan.
So, to be honest, this is not something that I've looked at in preparation for today's meeting. James mentioned that there's some language from the 37 Act that this parallels. But as we were looking at it, and I was reading it for the first time now, it reminded me of Prop 162, which is that big piece of in the Constitution, now part of the 37 Act that the voters approved in the early 90s, that has parallel language, and I don't know whether it matches identically or not, and you're raising a good point, I think, which is, if you do make some changes, what's the significance of that? And I'm not prepared to say right at this moment.
Mr. Jordan?
If it's not essential that we adopt this today, could we ask that be researched? And the suggested language I would offer is in place of the second half of the sentence where it says minimizing contributions, simply go ensuring that plan contributions accurately reflect the full cost of operating the plan, the full normal cost.
My question there is, this is an investment policy statement. This entire discussion seems to be off topic to investment policy. This language is about, and this is not new language. This is in the investment policy as it stands now. It's redlined because it was moved from elsewhere to up front. It's what we currently have. It's, I believe, very much in line with the fiduciary responsibility language in the 37 Act and elsewhere, maybe. Changing that, I'm concerned, would create potential conflicts and put multiple conflicting fiduciary responsibilities upon the board, so I would be concerned with that. And going off, in this direction to talk about things other than investments in the investment policy statement is a concern, so.
Hold on a second, hold on, Mr. Jordan.
I think that conflict is inherent in the 1937 Act and in the roles and responsibilities of this board, and it was topic number 1 in our 2-day retreat. So, it's not going to go away by not addressing it in the policy.
Mr. Sakowitz.
Thank you, Mr. Chairman. So to legal counsel, essentially, I'm going to paraphrase what I think that paragraph means. Essentially, in this investment policy statement, we, the board, are saying we're going to do the best possible job we can in managing this portfolio as to minimize, to the greatest extent possible, the contributions that will be required by the plan sponsor and its employees.
Doesn't say
Correct? Is that, am I paraphrasing correctly?
I don't know whether you're paraphrasing it correctly or not, but what you're saying would be fine if that's what it said.
Is that what it
And I
says?
have no reason to believe that this language isn't appropriate. But if you want to propose some changes, I'd want to actually have the language in front of me and give it a little bit of thought.
Okay.
So this is the language that you already have in there. I'm assuming that it's consistent with Prop 162 and the 37 Act. I have no reason to think that it's not. But if you want to propose some changes to it, that's fine, that's your call. And then I would want to have the opportunity to have that language in front of me and give it a little bit of thought. It is just the investment policy statement, so
Right.
it's not going to be, the end of the world if there's
Mr. Knudsen.
some little bit of inconsistency, but let's get it right.
Yeah, I was gonna say, when I first read this, I I knew I read it before, now I remember investment policy, and I agree with James, I think it's almost word for word what's in the government code. And I don't think we as a board can vote for something that conflicts the government code.
Mr. Shoemaker?
I think if you read it in the KISS mode, as we've heard earlier, it simply says minimize contributions. And we have sponsors and we have members, and they all contribute. And we'll minimize all their contributions.
Okay, we have a motion on the table, let's take a vote. Judy, roll call.
Ms. Cavaness?
No.
Mr. Sekowitz?
No.
Supervisor Jordy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
No.
Mr. Knudsen?
No,
Ms. Harris?
No.
Ms. Shopmeyer?
No.
Mr. Goodman?
No.
Thank you.
Motion fails. Okay.
Can we state, can I just ask something about this? What's happening with this? It's gonna go back?
No, there was a motion to change that one bullet point, it failed, so we're moving on.
Okay, but, so does that mean that this is adopted as it was?
No,
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 we were just
bring up
voting
your
on
point.
that, now we're gonna continue reviewing the policy.
Okay, that's what I was,
Yeah.
make sure I didn't get this.
Okay. So, anybody else have anything regarding the investment policy? Ms. Shabbat?
On the bottom of page 14, and I don't know if this is PIMCO, and I may be even looking at this wrong, but it talks about loss of key personnel or change in ownership. And it's saying on here that the loss of key personnel will normally result in termination of the manager. And I was wondering if maybe that should be like loss of key personnel may result in termination of the manager, like, I mean, cause is this the PIMCO scenario, or is this something different?
well, it said normally. Could
Well, normally, but like in PIMCO, of course, we didn't do anything. But I'm just thinking, I mean, normal, it's kinda saying, well, normally is kinda saying like, that's the normal process that would happen. But yet, but we had PIMCO and that didn't
Well, it
happen.
says loss of key will normally result in termination of the manager.
Right, but if it
I
just
can
could
be
say,
very comfortable changing will normally to may.
and then there's another part in here that could say
Second
may.
sentence, Jill.
Yeah, it just, yeah,
One bullet.
So,
yeah.
you're gonna change loss of key personnel will, may result in,
Yes.
In termination of the manager, and then a material change in the ownership of the manager may result in the termination of the manager. Was it? Yeah.
do we need a motion on that? Or is that just direction to staff?
Well, it's in the sign, so you're gonna vote to.
Correct.
Policy.
Yeah. All right, so, any other? Okay, nobody has any other issues regarding this? Okay, let's, do I have a motion to adopt the investment report with the changes to the one paragraph on page 14? Is it 14?
So moved.
Second.
Okay, we have a motion and a second to adopt the investment policy as written, except for page 14, where James has been given, Dr. Wilbanks has been given instructions on changing the language. All right, Judy, roll call?
Okay, Ms. Cavaness?
Yes.
Mr. Sekowitz?
Yes.
Supervisor Jordy?
No?
Mr. Stevens?
No.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes,
Ms. Harris?
Yes.
Ms. Shopmeyer?
Yes.
Mr. Goodman?
Yes. Okay, motion passes. Okay, moving on to item number 6, discussion and possible action regarding revocation of cash management and rebalancing policy. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the memo, you have the policy. With the adoption of the new investment policy, the pertinent language from the cash management rebalancing policy has been added there. Recommend revocation of the separate policy.
So moved.
Well, so moved is not a motion.
just clerk.
I'm sorry.
Mr. Knudsen?
changes is you've moved some of these to the investment policy,
That's correct, yeah.
but they're not redlined here. I think your note said you weren't gonna redline them because they wouldn't they all be everything that's gone?
Right,
But you had said in your memo that you weren't gonna do that because it would be
yes.
confusing.
If I deleted it, it wouldn't show up, and so, yeah, it was very confusing.
Okay. Anybody else have any questions? Ms. Harris?
I move that we revoke the cash management and rebalancing policy.
A second.
Okay, we have a first and a motion and a second on revocation of the cash management policy and
Is it,
cash management and rebalancing policy.
is it revoke and replace?
No,
It's already
because the
required.
language was adopted into the investment policy. The
I got
pertinent
it.
language is adopted into the investment policy statement.
Got
All
it,
right,
got it.
all in favor, say aye.
Aye.
Any opposed? Okay, motion passes unanimously. Okay, item number 7, discussion and possible action regarding investment consultant request for proposal. Okay, Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have a memo at hand. Last year, we had talked about possibly issuing an RFP for investment consulting services. The board at that time decided to wait. It's now time for us to consider that again. The contract with our current consultant expires at the end of the year. We did not spend time and effort drafting an RFP. We learned our lesson from last year. So we will do so if the board wants to move forward with that. If you do not want to spend time on that, we can entertain conversations with our consultant to pursue another 1-year extension with them. It's up to the board.
Mr. Shoemaker.
What was the length of the original agreement?
3 years.
I believe it was a 3-year with 2 1-year extensions, and we've now gone past that once or twice? Once? Okay.
So if we decline to do an RFP, would we consider a new 3-year agreement?
That is an option that would be available to us. We could do a new 3-year agreement. We could do a 1-year renewal. It's up to the board, whatever you choose to do.
Ms. Harris?
Personally, I'm very happy with what Callan has provided for us. So whatever the board's pleasure is, if 1 year is a minimum and 3 years a maximum, I'd like to see us at least continue for a period of time to work with Callan on our investments.
Mr. Knudsen, did you have any?
I was gonna make a motion,
Oh,
move that we enter into a discussion with Callan to establish a new 3-year contract.
I'll second that too,
okay, any discussion?
for discussion.
Question to legal counsel, as advising us as fiduciaries, is there any responsibility to RFP investment consultant on every 5-year basis, 10-year basis?
So I think that's a good question, and like with most issues with regard to fiduciary duty, it's reasonableness. So if you didn't do it in 20 years, that wouldn't be reasonable. You might be getting to the outer edge of, if it's been 7, 8 years, that sounds like a little bit long to me. So, maybe 3 years on top of what you already have, maybe you're getting to that outer edge a little bit. So it's hard to say, but
Would a new 3-year contract be reasonable in your opinion?
if you've been with them for 7 years and then you'd be at 10 years, that might be about the outer limit. I'd say you could probably do 3 years, and at the end of that, you probably want to do an RFP for sure.
Thank you, sir.
Mr. Jervy?
Could make a motion, consider changing it to 2 years, and also, the other thought I had was the fact that this came to us in September and it concludes in December. I think when it does come back for the board, it needs to come back, like, say, in June of the year that it expires. So I would like to see a 2-year extension with it coming back to the board 6 months prior to the end of the term for an RFP process.
You'd have to amend your motion.
I like 3 years. I think we've had 4 years, this would be 7 years in total?
We've had 6
I
years.
thought it was 3 with 1 extension.
3 with 2 1-year extensions and then an extra 1 year, so this will be 6 years.
I think that's about.
Calvin's been
If-
here since I've been here, and I'll be here 6 years just so.
If I withdrew my second, would that,
Well, I could change my motion, because I thought had 4 years and we were going to go to 7 years. But if it's
So now
10 to
it's-
6, it would put us at 9, then.
okay, yeah,
At this point, I think I'd amend my motion to extend
years.
it 1 year.
oh.
Why don't you withdraw your original motion, make a new motion?
Yeah, I withdraw the second, let's do it
Let's
again.
start over. I withdraw my motion.
And I withdraw the second, and I like the idea of the 2 years with it well in advance.
And no question of if we're going to RFP.
Before we make the motion, I want to hear from Mr. Walker first.
I'll withdraw my question.
Okay. Mr. Knudsen?
I'm simply gonna withdraw.
You gonna make a new motion?
I'm thinking, well, in the back of my mind, when Jeff was explaining things, I felt we had a policy on how often we were gonna look at our, like actuaries, consultants, that kind of thing.
I am not seeing a policy that speaks directly to that. Yeah, I'm not able to put my finger on anything specific
Mr.
from
Stevens?
such short,
What was the cost, annual cost, when we did the original RFP with Callan? I'd like to have before I vote on this, I'd like to know what the original cost was and what it's been the last 2 years. Because I think cost does matter. I mean, Callan's done a great job, thank you for you guys, it's kind of clumsy having them here when we're discussing this, but.
they're used to it.
Pardon me?
It's not personal, they're used to it.
But from a fiduciary standpoint, I think I should have something in front of me showing what their cost was when they did the original RFP and we hired them. And then I'd like to see what the cost is today. And if it's reasonable within inflation and the extra work they're doing, then I would vote for it. Otherwise, this fiduciary can't vote for it because I don't have that cost information.
Craig, do you recall, I want to say, I don't know what the original was when Callan was first retained. I'm thinking the renewal was Stan, somebody, numbers?
I think it was an extension of the current fee, right?
Yeah, so I believe our fee is about $150,000 a year.
That's what I was thinking.
Plus or minus something,
Today?
yeah. And we have a 3% annual inflation adjustment, though we didn't for the first few years, I think. The first few years, there wasn't that, and it's just subsequent years, it goes up by 3% to account for.
How do you score the 2 1/4 and the 3?
We're a business. They use the Bay Area CPI.
Yeah, right.
Ted, you're not suggesting 3% for our plan, are you?
I'm suggesting 2 1/4 for Callan.
And we're in negotiations for a new contract. Okay,
God, I
let's,
wish Angela was here.
Maybe they gave them the CPI.
The exact number is 145,600 at inception, I'm being told. And now it's increased a little bit by the 3% per year to 153 is the number that's coming to my mind, I'm not sure.
So 140,
6
40 to
to
153.
153. Essentially the same fee
Okay.
by and large.
So we need a motion, right?
I'll let somebody else take a stab at it.
I'll make a motion for a 1-year extension with a 3% inflation adjustment.
I'll second that, but if we clarify that we will be putting out an RFP, staff will start working on this in June, so it's done timely.
Yes.
June of the final year.
This would be the final year.
I'd rather have
So we have a
2
motion, do we have a second?
I second.
Oh, you said, oh, you did, okay. Discussion, Mr. Shoemaker.
I think that everybody is probably satisfied with the service we're getting under this contract. And just another 1-year extension, I think it'll be at least 2, I don't even have a problem with the 3-year. But if you do a 2-year extension and you set up for an RFP 6 months earlier, that really means only a year and a half. So,
I agree.
you know, I think we should have a little more respect for the service they've done to us and award a contract rather than a silly extension.
Yeah, I agree with you.
Yeah, I agree with 2 years.
So we have a motion on the table.
I'd be okay with 2 if you want to amend the motion.
All right, I'll amend the motion for 2 years.
I'll second.
Withdraw and then redo it.
I withdraw my motion. Make a motion for a 2-year contract extension with the built-in inflation adjustment of 3%.
And the RFP.
And with the RFP,
At the end of 2 years.
at the, right,
Well, 18 months.
18 months from now. And I would think that RFP is pretty much cut and paste from other RFPs out there.
Got the motion, we have a second.
Yes.
Okay, Mr. Jurdy seconds it. All right, any discussion? So, motion to extend Callan's contract for 2 years with a 3% inflation, with RFP coming in June, in 18 months. Okay, any discussion? Okay, Judy, roll call.
Ms. Cavanagh?
Yes.
Mr. Sakowitz?
Yes.
Supervisor Judy?
Yes.
Mr. Stevens?
Yes.
Mr. Walker?
Yes.
Mr. Knudsen?
Yes.
Ms. Harris?
Yes.
Ms. Shatner?
Yes.
Mr. Goodman?
Yes. Motion passes? Pardon?
Now might be good.
Okay. Break, 10 minutes?
I already had mine.
Okay, well, you
You
can-
carry on.
You and
I
John.
I already had mine. I don't need to go now.
Okay.
You carry.
On the monthly financial report.
It probably has something to do with the largest
Time to make a motion.
Yeah, were you motion?
Dr. Wilbanks.
Where are you?
Is there a doctor in the house?
Get down the hall.
So for clarification, we have monthly financial report.
Yes, monthly financial report.
Our taskmaster.
He's good.
Yeah, you don't have to worry about the meeting.
He's a good chairman.
All right, do we have any questions on the financial report? It looks like we have some negative cash. What happened there, Stan?
There's, some of that's related to the prior month where we tried to raise from the real estate fund. It took a little bit longer than anticipated. And there's some noise going on with the year end. And they're hard to forecast June and July's cash.
So we borrowed from the county? Is that what happened?
A little bit, yeah.
Did we pay any interest or anything on that?
Just a tiny amount. James.
You want to answer that? Oh, I could.
Pennies.
The pennies, yeah, it's based on a quarterly average balance, daily average balance, so,
Wow.
yeah, so I mean, it's, yeah, and even at that, it's like, you have, our pool is very low percentage, it's like 40 basis points, 50 basis points probably. So yeah, pennies.
Anybody else? Mr. Stevens?
There has to be a timing issue going on there. Why are contributions so low compared to our benefits and administration? Did we miss a contribution cycle just because of timing?
Yeah, I saw that too. Yeah, it seems like it's a little lot though.
It's like about twice what I expected it to be.
So, tell me where you're looking.
So I'm either looking, if I look at this statement of changes in net plan position, I'm looking at total contributions of 1.2 million. I'm looking at total deductions for the period of 2.7 million.
Yeah.
I also see it in, cash flow analysis, total contributions 1.2, deductions 2.7. You have $1.5 million. I expected it to be about 700 or 750,000.
Yeah, so that's part of the accrual that happens over the year end. So, at June 30, we accrue those contributions, so, you can see on the cash flow statement, you can see the adjustments for that, those changes in accounts receivable.
So I'm a little lost on that. I was thinking it was just purely timing. You're telling me that is, so what I saw at the end of the year on our last report was incorrect?
No, we accrue the contributions, because that last pay period, 90% of that last pay period for June 30 is accrued.
Okay,
As
so,
of June 30, 2016, and 10% is, on July, the next fiscal year.
Mr. Knudsen?
Well, I went back real quick and looked at July, or June 30th, and the total contributions were $2.7 million, so that's what he's saying, is that they accrued it back into June.
Yeah.
I think our norm,
That's a better way of saying it.
yeah, but it was almost 2.8 million last month.
with the other adjustments, it will reflect accurately for the year-end statement.
Yes. Yes.
Okay, thank you.
Okay. Anything else on the monthly financial statements?
Just quickly, if I,
Mr. Knudsen?
when would we start getting August and September instead of July and September?
The financial statements, we will continue to have a lag on the financial statements because of the process for the county closing their books on the month end. Is that, Stan, am I saying that accurately? Or am I missing something else?
Yeah, that's one of the reasons.
So our investment reports are accurate now, we can get that, we just can't get our financial statements, we're still a 2-month lag on that.
Right.
You can get preliminary, but it would be pretty close. Okay. Moving on to item number 9, discussion of possible action regarding strategic plan and mission statement. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the current strategic plan, vision, mission statement, and everything else. It is on our policy review calendar to review this in the third quarter of every year. Bring this back to you. We have not, you'll notice we have not had a strategic planning offsite this year. I was well, frankly, we've been really, really busy. There's been a lot going on. And I thought with the board turnover, or potential board turnover that could be coming, it might be best to wait until early spring to think about a strategic planning offsite. So wanted to stick with our policy review calendar and put this before you. I have no recommended changes, but it needs to stay top of mind, so we're going to continue to review this every year.
I appreciate having it on our agenda. I think, I believe in the policy statement, strategic plan. Glad we have it.
Okay. Anything else regarding item number 9? Okay. Move on to item number 10, discussion regarding Marin County Retirement Association court decision.
We'll leave that open, John.
Oh, keep it open. Dr. Wilbanks?
Thank you, Mr. Chairman. Trustees, you have a memo in your board packet from esteemed legal counsel and lowly retirement administrator. I would be happy to have the legal counsel answer any questions that you may have.
Way to putt.
Mr. Stevens? Anything on this?
I do have some questions on it. So it has to, I was gonna let the retirement administrator finish up what he was saying. I wasn't here, unfortunately, in the May meeting where we reaffirmed for our PEPRA and non-PEPRA what's pensionable. Yet I know that when in December 2012, I think is when it was, when we went and did it before, I was pretty uncomfortable with that because it seemed like PEPRA for even non-PEPRA for all employees suggested one thing, and we made a decision on a board that the California rule precluded us from adjusting anything we've traditionally had as pensionable. It appears that the Marin Sarah case has changed that. And that we would have, our role is to have reasonable benefits. And if PEPRA has suggested something in that language for employees that have legacy before PEPRA was enacted, and as long as it was still a reasonable pension position, it would be open to discussion on whether it was a pensionable item or not.
And what's your question?
My question is that if this Marin Sarah ruling appears to open the door to have items that had a legacy of being pensionable items, to change that going forward.
Yes, that's true.
Prospectively, not
Yes.
retroactively.
Correct. If this Marin decision stands, and I'll explain that in a minute, I think it would give the board the ability to say, stand by and on call, do not have to continue on a go-forward basis. So the plaintiffs in this case, the unions in Marin County, have until next Monday to file a request with the California Supreme Court for a petition to review. And from all my understanding is they are gonna file that petition, and then it's up to the California Supreme Court whether they wanna hear the case. The other piece of this puzzle is that there's another action pending in Contra Costa County. Contra Costa, Alameda, and Merced brought actions against their retirement systems, and those actions were all consolidated. In that case, the trial court actually reached a different conclusion. They said you have to look at each member and to see whether they didn't even get into the vested rights piece as much as the substantive question about what on-call and standby mean. And so it has to be work within your normal working hours. And the trial court issued a decision that said, if somebody's getting standby or on-call, and they're regularly scheduled, it's mandatory and recurring, and they still get it. That's the trial court in another lawsuit. Kind of reached a little bit of a different decision. That case is now in the Court of Appeal, and they've briefed it, and they're ready for oral argument. So they haven't issued a decision yet, and then they have, in kind of a sister court, a different division of the same Court of Appeal, reaching maybe a different conclusion, but now petition for review. So it's going to be very interesting procedurally to see what happens next. So it's kind of stay tuned. And it may be that this Marin decision becomes final and the other consolidated action reaches the same conclusion, may reach a different conclusion. And I actually went back to look at the video of our board discussion in December of 2012, and the board did a great job of identifying the issues, and we talked about how the systems were split, and you can kind of see why. And we have something in our resolution. We anticipated that there were going to be lawsuits, and we said if we get a court decision that's different than what we have laid out in the resolution that the board adopted, that we'd make a change. And so, we're bringing this to you today as an informational item, and, maybe next month we'll have more information.
Yeah, what I remember clearly from that meeting is the board reached decisions because even though PEPRA said one thing, this board thought it was not right because of the California rule, and the California rule superseded what the legislative body had passed. So my only request is when we get some certainty on it, we bring it back and review it.
Absolutely.
Mr. Knudsen?
Yes, I thought, our legacy employees, pre-PEPR employees, the compensation earnable was determined by the Ventura decision. We were ordered to adopt these different pay types based on the Ventura decision, and we couldn't change that. PEPR laid out what should be compensation earnable, so that's a different situation. Is this Marin lawsuit superseding Ventura's lawsuit?
In part, yes.
Can they do that? Who's the higher court?
Well, we'll have to wait and see. You're right, the Ventura decision was in the 1990s, and it basically said everything paid in cash has to be pensionable. And so that's where the idea of the standby, with some exceptions like overtime, clearly was out. So there was standby and on-call, and, for years and years until around 2012, until PEPR was passed. And that was one of the things that was talked about in 2012 when the board decided to continue to include it, as well as half the 37 Act systems. And half didn't, and half of that half got sued, and now we're gonna find out, what the final decision is.
Stay tuned.
Jeff, could you just explain some of the different scenarios of how this could go through the courts? Because it sounds like maybe there's more than one. The state Supreme Court could decide to hear the first case.
Right, the Marin case.
The Marin case.
Uh-huh.
Could they also postpone hearing that and wait for an outcome if there's a potentially conflicting outcome at the appellate court on the Contra Costa case?
So,
And merge the two together?
sure. So the Marin case, we'll get an answer. The California Supreme Court will either grant review or not. If they grant review, that means that this case can no longer be cited as precedent. It's almost as if it doesn't exist. That's just how the law works. And then the California Supreme Court will decide the Marin case. If they turn down the request to hear it, then that Marin decision becomes final. If there were no other cases out there, that would be the law. If this other case, they're probably going to wait to see what the California Supreme Court does before, I would think, the Court of Appeal hears oral argument. So that case, if it was just operating on its own, it might take another 6 to 9 months before we got a decision there. I think the California Supreme Court has 90 days to decide if they're going to hear the case. So we'll find out probably about the Marin case first, and then I'm sure the Court of Appeal in the consolidated cases, Alameda, Contra Costa, and Merced, are going to wait to see what happens. That's my guess. Did that answer your question?
I think it did, and so I guess since we want to hear this when we get the final decision, I guess it seems to me it's not so much important whether it comes back next month. It comes back to the board when we know what the ruling is.
That's the plan. Yeah.
Mr. Walker?
A question for Jeff. My understanding is at this point that it's on, the benefit that's in play is the standby.
Standby and on-call.
On-call. Is it possible, either as a result of the Marin decision and or the Contra Costa decision, that there might be some other components here that...
So James and I took a look at the list, and we don't believe that there's anything else. They're either benefits that are being provided because of value added, or specific things that are just different. And they're not allowed for new employees, like, I don't have the list, I have it somewhere, but like housing and the clothing allowance. Let me see if I can find it.
Car allowance, those kind of things?
Yeah, I think that was on
In the material that was handed out, there's a separate breakdown for, I guess we're referring to it as legacy and PEPR.
Yeah, so for the new employees, the PEPR employees, there are specific things that the law, when it was passed and enacted in 2013, specifically exclude, but it's still allowed for the legacy members, and that's things like employer-provided allowance, reimbursement, or payment not limited to housing, vehicle, uniforms. So you'll see that there are just some differences between what the PEPR people get included and what the legacy people. But for purposes of the resolutions that we passed here, my understanding is, and pretty confident that it's really, we're only talking about standby and on-call.
So doesn't affect the vacation payout and, or sick time or?
Vacation payout, the law confirmed what we had all had thought, which was that you can only cash out what you would have been earned and payable in a 12-month period. And so to the extent that the employers still allow for some cash out, it's limited to that. I do believe, though, that that is an issue from a vested rights standpoint in Contra Costa. And in those consolidated cases, because I think that historically they had been allowed to cash out more than what they had accrued in 1 year. And so that was a big ticket item for them. I don't think the standby and on-call has the materiality that the cash outs do. And I'm not that familiar with those, with the substance of those consolidated cases, but I think the vacation piece was a bigger deal.
I thought the Marin, the court said that you're entitled to a reasonable pension. So I mean, to me, that would put everything in play. What's reasonable?
Good point.
Well, yeah. The question was about vested rights. And so you have to look then at what the law actually says. So now you're not getting past you're not into a vested rights question anymore. It's more about the substance of what the law says. And the law said for Pepper people, these items are excluded. And they did make some changes for legacy members, but they didn't make those same changes. So I don't know that it's, if I'm understanding what you're saying, I don't think it's as
Well, the
a
court
big
said
an issue with
you're-
regard to
okay,
the.
well, I thought the court in the Marin said you're entitled to, you're entitled to a pension, but you're entitled to a reasonable pension.
That's true.
So to me, that could just be your annual salary
We'll give you
over a
$10.
certain number of years,
So
and not
perhaps,
include any of this. You
So I
know, to me,
suppose
you
if
could
the
get rid of all these.
if the legislature makes a statutory change, right now you'd be going, in other words, if you said, I'm going to, or the board wants to eliminate, housing vehicle uniform allowances, you'd be running counter to the statute. So it's not even a vested rights question, because you're just being consistent with the law, because the statutory interpretation would be if the legislature wanted to exclude housing vehicle and uniforms for legacy members, they would have added in that language, and they haven't. Does that make sense?
Mr. Stevens?
If this Marin Sarah case stands, and the Board of Supervisors decided that back in 2002, 2003, 2004, whenever, they enhanced benefits, that was too rich, and they wanted to change those prospectively, not retroactively. Would this give them some authority to do that?
So, I want to be mindful about the role of this board and the role of the Board of Supervisors. In fact, I anticipated
This
that
is a
question.
fiduciary question.
I put it in my memo that is a benefits question for the Board of Supervisors. So you're asking me my opinion on an issue that
I'm
may
asking you
come
as our
before
legal
the-
counsel, on looking at this case, if it stands, whether the California rule could be reinterpreted.
So, that's still not our issue or my issue, but I will tell you that, of course, yes, this Marin decision would be something that proponents of wanting to change that formula, they would cite to this case.
Thank you.
Anything else? Okay, this will definitely be brought back when the dust settles with regards to the Supreme Court's going to hear whatever happens, so it will definitely come back. All right, move on to item number 11, Retirement Administrator's Report. Dr. Wilbanks.
Thank you, Mr. Chairman. Trustees, you have a lengthy report. I will touch very briefly on a number of items. We do have our IRS determination letter. Yay! I did include, there was a report from County Council that's been mentioned here several times regarding what I call it a survey of past actions of the Board of Supervisors and some of the Board of Retirement. that was presented to the General Government Committee of the Board of Supervisors. I've included that report here. We now have video clips up, or an access point on our website where our members can go and see segments of our Retirement 101 presentation. Hopefully, people will take advantage of that. So we had to go through some effort working with Scott we had a recording of the entire hour and a half presentation, and I thought that would be unwieldy, so we worked to edit that down into smaller bites where someone can go and look at a 3-minute clip of the benefit formula, so it's more digestible for clients. Pension administration report, everything is moving along nicely. We are approaching the end of our contract with Linnea. We have no plans to renew that. That contract expires at the end of December 31st, end of December this year. Essentially, we are almost done implementing all the pieces of Pension Gold. The EDMS is almost done. You'll notice when you come in today, the file cabinets are gone. It's because the paper's gone.
Where did the paper go?
The paper is currently off-site. The vendor that did the imaging is holding it for us until the carpeting is done. It will come back, but it will come back only for some QA purposes, and then we will destroy it. So.
Is that a local vendor?
Sacramento. And staff is reporting that they're very pleased with the imaging and not having to spend time retrieving and returning files. It's all right there. Just pull it up and go. We did, Monday, we sent out a notice to all active employees about the portal. So we have pushed as much as we can on the portal. We have now sent notices to all retirees that we have email addresses for, and all active members that we have email addresses for, that the portal is live, and they can go in there and create their estimates, look at their information, create their estimates if they're active, look at notice of deposit if they're retirees. So that is a question.
Oh, yes, Mr. Stevens.
Can we have a demonstration on that when it's up and running?
On the portal?
Yeah.
Or the imaging, or pension?
The portal and how it works, just what an employee would see if they went in and how it works.
Absolutely.
What they can do on it.
Absolutely.
Thank you.
Absolutely arrange for that. The maintenance update, there's a lot going on, as you notice. I don't know if anyone's really noticed it today, but there is not nearly the amount of noise coming in as there normally is. That's because the door is gone. Very, very happy with that. Carpet, we've talked about, I think I've talked about most of you. Carpet is getting replaced next week. Staff will be out of our building next week. Our staff will. The flooring company is replacing all of the flooring in the entryway and our space next week. The big storage container out front is where they're going to put our furniture while they're doing all the flooring. We do know where we're going. It's the old GSA building on Logat. The county secured some workspace for us there. That's where we'll be working. What else? Windows are on order. Should be here late October, and then exterior paint will be done immediately after that.
Yeah.
What about these things?
Blinds.
Dump those?
It's in the thought process.
Do you want-
Haven't yet
I don't want
finalized.
them.
But yes, that I'm aware that I don't like these, and would be very interested in getting something that is befitting a professional office.
Yeah.
So,
Mr. Sakowitz.
Thank you, Mr. Chairman. So, Dr. Wilbanks, we were talking during the break here about the cost of the carpeting, which you estimated at $80,000, $20,000 of which is a premium for this prevailing wage business.
give or
I
take.
mean, I know what it takes to claw and scratch for a training around here. I mean, 20,000 is like is like 2/3 of our training budget, or maybe it's the whole training budget. That seems like an enormous amount of money. Can you explain how that works, prevailing wage?
It's the law.
It's the law, I know we're subject to it, we have to pay it.
Even if we were a special district, we'd have to pay it.
Yes. Pretty much, I believe every government entity in the state of California has to pay prevailing wage on any project.
And if you receive government funds as a nonprofit, you may have to do it as well.
So we have to pay what a contractor would be paying for, we'd be paying a contractor what you'd have to pay for in San Francisco?
That's correct.
Holy moly.
Who's that, Marin?
So, and it doesn't look too bad, but we're not painting before we get the carpet?
We will have some touch up, the wall back there and some other things. Not the entire office is getting painted, but we'll do that after the carpet.
After the carpet?
Yeah.
The exterior's getting painted fully, is that?
Exterior is getting painted fully, yes.
Yeah.
Yeah, that's separate. Yes.
All right.
We have posted notice that the office will be closed next week. We just found out where we're going, so we'll update that notice on the website and the front door. That will be working elsewhere. The other side of the building still has to get done with carpet and tile, and that will take place after the fact. And we're working with the Department of Rehabilitation to see what works for their schedule and how we're gonna lay all that out, so.
What's the total budget?
For carpeting,
For the whole thing? How much were you to spend on this whole?
the bid was just under, I believe it was $79,600 for the whole thing. And
That's carpet.
carpet, yes.
For both
Both sides, yes.
Oh, that includes, the Reynolds area?
Yes.
Oh, okay.
Yeah.
How about the whole upgrade project? Do you have an updated number on that?
I do not. I know the budget adopted this year had, I believe the number was $161,000 in it. I did get an update from the building manager or the project manager on what they've done for us this year, but it didn't include any of the carpeting or paint or windows yet. I believe we're gonna be under that number.
We'll see it on our budget report.
Yes, absolutely.
Okay, anything else?
Legislative update, AB 1853 is still on the governor's desk, awaiting action. AB 2376 was signed and is enacted. So I'm not sure of the effective date on it, we'll have to check into that. Is there anything else? Not on specifically here, we do have, there is an upcoming Sackers event in November, if anyone's interested. I would encourage you to let Judy know as soon as possible. And then I'm gonna hold on to the other ones. That concludes my report, Mr. Chairman,
Okay.
unless there are questions.
Mr. Stockwell?
Will we be getting out a press release on the IRS's determination letter? I mean, that's huge news, and I know a lot of people have followed that.
Had not thought about it. We could certainly put something together.
Does the board think that would be a good idea?
I think it'd be a good idea, yes.
I don't think it's necessary.
I mean, I don't think we've had a lot of luck with our press releases anyway. Good.
I think we should try. All the bad news gets out there.
Yeah, we got a lot of bad news out there. This is pretty good news.
Did you expect different?
I just know it took a long time and a lot of dollars to tax council. And a lot of effort.
Okay, we're going into closed session.
Could we do the general board discussion before? Is there any reason we wouldn't?
I'm fine with that.
Sure.
Okay, so the reason, what I'd like to bring up is sometime like today was an excellent example with Cowan here talking about the inflation rate. It's thought that it is out of place to discuss some of those things. As a fiduciary, this fiduciary, when you look at the performance of this board and having put our county in a negative net worth position, and creating an environment where the sponsor of this plan is paying the outrageous 46 cents on every dollar of payroll, about five times what the employees are paying. This is mind-numbingly complicated. And if you have an investment advisor that's done some modeling for you, you can't ever, I'm a financial guy, I live this every day. A lot of times you have to process this stuff if you are on top of it. I'd make a pretty good argument that we haven't been on top of it, or it wouldn't be such a disaster that the results we have of this plan, because our role is to fund this plan. We've done a terrible job of funding it. So what I would like to ask for is the understanding of this board. If we have things come up and you have a professional outside, we always say we defer to our professionals, and it's a legitimate question. We allow that question to be answered rather than cut off someone. I know it may be annoying you to get off topic, but there are a lot of cracks that need to be filled in, and it is my belief we really have to look at this seriously, because if someone outside took a look at the performance of this board, we would not get a very high report. I know we like to pat ourselves on the back. This board, responsible for the funding of this plan, has put our county, because of the debt we've incurred, and it's rest on our shoulders, has put our county in a negative net worth situation. This board, because of the way we've funded, which is totally our responsibility, not the supervisor's responsibility, has created a situation that if this sponsor was a private employer, could not be in business anymore. So I think when you have professionals, whether they're actuaries, investment advisors, legal counsel here, and things come up, we should have a little latitude. That's my request.
We do have latitude, but we also have to be in consideration of the Brown Act, okay? All right, anybody else? Mr. Jordan.
So I wanted to give an update on something. So, you know, at the end of each year, and this does not have to do with the unfunded liability, but at the end of each year, there's a true-up, my understanding, with the Retirement Association, and so if, let's say, if there are fewer vacancies in the county system than was maybe anticipated, then it could be that there was supposedly more contributions came into the system than expected, and so that happened this last year, and so in the CEO's report at yesterday's meeting, it showed that there's kind of a refund, if you will, at the end of the year to the county of like $300-something thousand. The year before, it worked the other way with greater vacancies, or at least I think that was the primary cause. And so the county had to make up the difference because the money didn't come from the employee or the employer, so the county had to make up the entire difference. Again, not to do that by liability, but it was $270,000. So at yesterday's meeting, under the CEO's report, when this information was brought up, the board agreed that we wanted to have a separate discussion on this and perhaps have a policy that says in those years where there is this refund that we would decide what the policy says, but we might say that it goes into a pension gap fund, which we've already established, or some policy like that, rather than just dumping it back into the general fund and and then it just sort of gets lost in the fund balance at the end of the year. So anyway, so that will be on a future board.
And that's Board of Supervisors.
That'll be on a
That's
future
good.
Board of Supervisors agenda.
Great.
And the line item was for how much?
This particular year, it turned out to be about 300 and something thousand. Stan, you may know the exact number.
And that's in Alan's budget book?
No, it's not in the budget book. It was in the CEO's report because it's sort of an end of year true up.
Okay. Thank you.
Mr. Knudsen.
This may be something new that wasn't going on when I was working here. We did that for the debt service on the pension obligation bond, but not with the county and the retirement system. So is it something fairly new?
As far as I know, yes.
Yeah.
Okay, I wasn't aware of it.
Anything else? All right.
I do have
Go ahead.
one update item very briefly. We do have board elections. The filing deadline was last week?
Friday.
What was last Friday? We did receive 2 candidate statements for the general member. So there will be an election there. We only received 1 candidate statement for the public safety member, so there will be no election. That member will be elected since they are the only candidate. So just wanted to update.
I have a question. I was wondering who that person is.
The public safety, it was Craig.
Yeah, that's
Oh,
right.
great.
That was my question.
Great.
And the general one, none of them was with me.
Oh.
So Captain Pierce doesn't want the job back.
So that's all I needed to.
All right, let's go into closed session. I'm not running. Yep. Number 1, board voted unanimously to grant Mr. Almeida a service-connected disability. Ms. Cavanis abstained. Mr. Almeida, a service-connected disability retirement. Ms. Cavanis abstained. It was, other than that, it was unanimous. Number 2, on possible exposure to litigation, direction given to staff. Number 3, on last item, direction given to labor negotiators. All right, so this, did you have something?
Before everyone leaves, if you used your tablet, we need to do the cleaner to erase your memory.
Oh, you mean on
Which
this?
fee?
Not like this?
So we leave it here to do that?
No, we'll do it at the conclusion of the board meeting. So you have an app on there called C Cleaner.
So I go turn it on and do it?
Seat cleaner does it.
So I just clicked on it, it's just gonna automatically kick on.
Seat cleaner,
All
I
you
thought
need to
just
do
cleaned
is
up
let
crap.
it run
Yeah,
down and
seriously,
it cleans
clean crap.
I
everything.
want Hillary's, what do they call it?
Bleach pit.
Bleach pit. I want the bleach pit, man.
Analyze and clean.
Where is it?
It's C Cleaner.
Oh, there it is.
I only see 1, 2, 3 tablets.
Jerry,
Four.
Jerry and
Mine's
I,
dead.
Dead too.
Jerry and I
dead.
gave our tablets back then.
We do recognize that these tablets are less than ideal, so we are exploring ways to improve the process.
Is this penny wise and pound foolish in regards to the purchase of low-end tablets?
That could be part of the problem.
Or
I
is
love
it
having a
operator error?
There may be some loose nut behind the wheel on occasion, issues, but
Ours simply wasn't holding the
Hey.
charge.
Well, you don't touch
You
it,
can't
you can't
let
hurt it.
Okay, next board meeting is scheduled for Wednesday, October 19th, 2016 at 8:30 a.m. at the Mendocino County Employees Retirement Association Conference Room. Meeting's adjourned.
Big,
So Judy, I just push C Cleaner?